Hi, Shae Russell here, editor of the Daily Reckoning Australia. And today I just want to throw back to an article written by news.com.au yesterday called Australia Could Be the First Domino to Fall. Now, it was quite a bearish article on the overall outlook for the Aussie economy and also to Aussie property prices, and as a result, the mortgages associated with them. We'll talk about the gloominess of the Aussie economy another day. Today I want to focus on sort of a tidbit that one of the quotas economists referred to. Oh, geez, I think I've lost the ability to talk today. Now, basically, there's been a lot of noise over the past few months about the danger of interest-only loans to Aussie banks. Now, this economist sort of dismisses that danger and he compares them to subprime loans in the US. And he says that interest-only loans are actually very different to the subprime ones in the US. Now, they are. To some extent, that is definitely true. So, for example, with the US subprime loans, they are often made to people with no income, no assets. But not only that, these people were people who could hand the keys back to a property and still not be liable for the debt. Now, the reason why is because the US has non-recourse lending. So that's why so many people could hand the keys back to their property and walk away and not be responsible for the debt. And that is a key difference to Australian lending. Now, Australian lending, while our interest-only loans, we'd like to believe, have a slightly higher credit profile standard, we most importantly have recourse lending. That means at any given time, you are responsible for the total value of the debt outstanding. And this is why in Australia, people just simply can't hand their keys back and walk away from the debt. And this is sort of a key thing that people like to bring up when comparing interest-only loans to subprime loans, is our inability to walk away from the debt because we are always responsible for them. So that is very true. They are different things. The problem, however, is that because we do have recourse lending, Aussie banks are basically incentivized to internalize the debt. Let me explain to you what I mean by that. Now, APRA have been reporting that just less than 1% on average mortgage customers are in financial hardship. Now, what that means is that there's a less than 1% of all bank mortgages across Australia are more than 90 days in arrears. So that's somebody who hasn't made a payment for 3 months. Now, that's what has to be reported to APRA. Once a mortgage gets beyond 90 days with no payment, that data must go to APRA. However, the data I'm more interested in is the data where less than 90 days in arrears, where people are making partial payments. So what I mean by that is essentially mortgage customers that have been referred to a bank's financial hardship department, because they do have them. And these are often people who are 30 days, 40 days, 60 or 70 days in arrears, but they're making partial payments, just enough to keep the debt collectors at bay and keep the banks on their side. And the reason is Aussie banks would much rather work with a customer and get cents on the dollar than nothing at all. Because once loans start to get to that 90-day mark, when no payment's been made, there's very little chance that they're going to get any money, recoup any cost back for that loan. So this is what I mean by Aussie banks are incentivized to work with people with their debt. The problem is the general public, we don't get access to this information. So that makes it very hard for us to quantify this risk to the banking sector. Now, when banks do talk about loans in arrears, they basically talk about it in their financial statements as going up or down a few basis points. But we don't know the total number of people or the total dollar value of loans that are being dealt with at the financial hardship team. So when it comes to investing in banks and banking-related stocks in Australia, we don't have a clear picture about how many people are facing financial hardship. And I do think this is what investors need to consider if they are spending money on investing in banking stocks and investing in the mortgage-related sector, is we can't quantify the risk of people in financial hardship. That's all I've got time for today. I'll be back later in the week with more. Thanks for watching. Make sure you subscribe to our YouTube channel for more video updates. Plus, right now, you can get a free guide to investing in gold. It's called The Best Way to Buy, Sell and Store Gold in Australia. You'll learn how to decide on what type of gold to buy, which Australian gold dealers to trust, whether you should buy bullion or ETFs, and the best and cheapest way to store your gold. All you need to do to get your copy is to click the link in the description below or go to thedailyreckoning.com.au/gold.